Just enjoy and listen to, and have a fun of it.
Have fun. Story radio station, what do you hen?
Welcome. I'm your host, always excited to dig into new topics, and I'm joined by our expert guide today.
And I'm here, ready to help us sort through all the information you've gathered and connect the dots.
Okay, so before we dive in, please take a moment to subscribe, like this, and hit that notification bell for Story Radio Station. Your support really does keep these deep dives coming.
Absolutely. And today we're tackling something you hear about constantly in the financial news, both globally and, well, right here, shareholder activism.
That's right. I mean, you see these huge names globally like Carl Icahn, Bill Ackman making waves. And then domestically, we've got various groups popping up, taking on big companies. It's definitely a hot topic.
It really is. And the conversation around it is so polarized, isn't it? On one hand, people say it's crucial, active shareholders stepping in to protect their investment when management is maybe passive or just not doing a great job. Especially important in markets dealing with things like undervalued stocks because of weak governance. Yeah, the Korea discount idea often comes up there. But then the other side argues it's just, well, selfish pressure. They call it unreasonable demands, just trying to pump the stock price quickly without caring about the company's future.
Exactly. So our goal today is pretty clear. We're going to look at how shareholder activism developed globally, what kind of strategies they use. Now, some are pretty sophisticated, and then really dig into the data. Is this activism actually a drug that boosts corporate value? Or is it more like a poison that harms long-term growth? Especially thinking about what's happening now.
Okay, let's get into it. Starting with how this all evolved globally, can you just give us a basic definition? What is shareholder activism, fundamentally?
Sure. At its core, it's an investment strategy. But instead of just buying stock and hoping it goes up, these investors buy a significant chunk specifically so they can actively step in and influence company decisions.
To make their own shares worth more, basically.
Precisely. Their main goal is boosting the value of their investment.
And like we said, this isn't some obscure strategy anymore. The numbers show, 252 companies globally targeted just in 2023.
Yeah, that's a 7% jump from the year before. And it's bounced back really strongly since that dip in 2020 when there were only about 173 cases. So yeah, activism is definitely mainstream now.
So what pushed it into the mainstream? Were there specific drivers?
Well, there are two really big structural reasons, I think. First, just the massive growth of the hedge fund industry. This created a whole category of activist hedge funds.
Specialized funds just for this.
Exactly. And the money involved is huge. Think about assets under management, or AUM. That's the total market value of the investments they manage. For activist funds, that number went from around $11.8 billion in 2003 up to $65.5 billion by 2012. Just, enormous growth in capital power.
Wow, okay. So a lot more money fueling these campaigns. What's the second driver?
It's about who they target. They've gotten very good at picking companies. Often it's companies that seem stagnant or maybe have obvious governance problems. That's a big one here in Korea, as you mentioned.
Or tech companies. I hear about that too.
Right. Tech firms sitting on huge piles of cash that maybe they aren't using very effectively. Activists see potential there, situations where they think they can force management to unlock value pretty quickly.
That makes sense. It's useful, I think, to look at the history here in sort of generations. Let's start with generation one, the raiders back in the 70s and 80s, people like Icahn, Kerkorian.
Yeah, that was the really aggressive era, sometimes even seen as predatory. Their main tools were things like junk bonds and the leverage buyout, or LBO. They were definitely not afraid of financial risk.
Okay, let's quickly break those down. Junk bonds.
Right. Those are bonds that are considered high risk because the issuer might, struggle to pay them back. So they have to offer really high interest rates to attract investors. Activists use these to raise the money for takeovers.
And the LBO, that sounds even bolder.
It was. Leverage buyout. Basically, they borrow money to buy the company, but they use the assets of the company they're trying to buy as collateral for the loan. It's like buying a house, using the house itself to guarantee the mortgage, but on a massive corporate scale.
Wow.
A famous example is KKR issuing something like $6 billion in junk bonds to take over RJR Nabisco back in 1989.
That's pure aggression, really focused on the takeover itself. No wonder companies started fighting back with things like poison pills.
Exactly. Defensive measures. A poison pill makes a hostile takeover incredibly expensive or difficult for the acquirer, and golden parachutes give executives huge payouts if they lose their jobs after a takeover, making the deal less attractive.
So the backlash led to Generation 2. late 80s, 90s.
Yes, things shifted. We saw the rise of big institutional investors like pension funds. Think CalPERS, the California Public Employees Retirement System.
Right, and they had a different approach than the old Wall Street rule, didn't they?
Totally different. The old rule was, if you don't like how a company's run, you just sell your stock and walk away. But these big institutions, they owned so much stock, and they were in it for the long haul. Selling wasn't always practical or desirable.
So they started to engage more.
They did. They realized that staying involved and pushing for changes could actually protect and grow their investments over the long term. And this got a huge boost in 1988. The U.S. Labor Department basically said that for pension funds, voting their shares wasn't just an option, it was part of their fiduciary duty.
Fiduciary duty, meaning their legal responsibility.
Exactly. Their legal obligation to act in the best financial interests of the pensioners, their clients. So suddenly, overseeing management and voting on proposals became mandatory. It turned activism from, potential predation into a form of responsible ownership.
Which brings us to Generation 3, the 2000s onwards. This is where activism really becomes mainstream, driven by these sophisticated hedge funds. They're not just doing hostile takeovers anymore.
No, it's much more complex now. They act more like financial engineers. Their demands are often about optimizing the company's structure or finances.
Like asking companies to spin off business units or sell assets.
Precisely. Or demanding changes to the board of directors. We've seen plenty of examples recently, right? Elliott Management pushing Crown Castle about its wireless tower business, or Value Act getting 7&I Holdings to think about splitting off 7-Eleven. It's more like surgical intervention than a full-scale assault.
And the tactics they use can vary quite a bit.
Oh, definitely. It's a spectrum. On one end, you have quieter dialogue behind the scenes, often called engagement, just talking to management, suggesting changes.
It can get much more aggressive.
Absolutely. Think legal pressure, lawsuits,
Yeah.
and the big one, the proxy contest.
Right, the proxy contest. That's when they try to get shareholders to vote out the current board members and vote in their own nominees at the annual meeting.
Exactly. It's a public fight for votes, and it is incredibly expensive and distracting for the company.
I saw a number. ExxonMobil spent something like $100 million just defending against one proxy fight in 2021.
That's the kind of money we're talking about. It shows how seriously companies take these threats and why they fight back so hard. The costs are just astronomical.
It's a huge deterrent. And there's this newer trend too, right? Funds like Starboard Value focusing specifically on tech companies that seem to have stalled, like Yahoo, eBay, Box.
Yeah, that's become a niche, targeting established tech firms, pushing for management changes, selling off parts of the business. It seems like almost any company could become a target if they show perceived weaknesses.
Okay, so we've traced the evolution, the tactics. Now let's tackle that core question. Is all this activism ultimately good or bad?
Good evening, and welcome to the Story radio station, where we explore tales from around the world.
Pause 10 seconds. Welcome back. We're diving deep into shareholder activism. Just before the break, we looked at how it evolved through 3 generations, from raiders to sophisticated hedge funds, and the tactics they use today, like proxy contests and demands for spin-offs.
Right. And now we're getting into the really crucial debate. The impact. Is it positive or negative overall?
Let's start with the positive case. The argument is that activists are like market watchdogs, right? They shake up complacent management, force companies to be more efficient, unlock hidden value.
That's the main argument, yes. That they improve governance and ultimately benefit all shareholders by making management more accountable.
But the counter-argument is strong too. The big concern is short-termism. Critics worry activists are just focused on a quick profit, pushing for things like huge dividends or share buybacks, even if it hurts the company's long-term prospects.
That's a major criticism, the idea of eat-and-run profits. Sometimes activists push for payouts that might seem unrealistic or unsustainable. You mentioned Flashlight Capital Partners and KT&G earlier.
Right. They demanded a dividend of 10,000 KRW, which was like double what management proposed.
Yeah.
And the proxy advisory firms actually recommended against it, saying it was too much, too fast.
Exactly. And this eat-and-run label also came up with funds like KCGI in the Ostom implant situation. They made a significant profit during the management dispute, then sold their shares. The critique was they didn't really stick around to ensure lasting governance improvements were made.
Okay, anecdotes are one thing, but what does the broader data say? There was a big study on U.S. companies, right?
Yes, a really important one. It looked at about 970 U.S.-listed companies that had successful activist campaigns run against them since the year 2000. The findings on long-term impact are, well, pretty sobering.
So what did it find? Is there a short-term bump?
There is, yes. Initially, corporate value does improve slightly. On average, about 1.4 percentage points higher over first 3 years after a successful campaign.
Okay, so a modest short-term gain. But what happens after that?
That's where it flips. The study found that after 4 years, the company's value actually worsens and falls, about 1.0 to a percentage point below where it was before the activists even showed up.
Wow. So the initial boost completely disappears, and they end up worse off. Why? If the company got cash from selling assets or something, couldn't they just reinvest it later? Does it damage something fundamental?
The data strongly suggests it damages the fundamentals. Let's look at what changes inside the company 1 year after a successful campaign. First, shareholder returns, like dividends, they shoot up, almost 15% higher.
Okay, so cash goes back to shareholders quickly.
Yes. Equipment, research and development, the stuff needed for future growth.
Let me just jump in. CapEx is basically investing in the company's long-term productive capacity, right?
Exactly right. And that spending plummets by nearly 11% in the first year after an activist wins. And the cuts tend to stick, leading to significant underinvestment long term.
So they're sacrificing future growth, future innovation for immediate cash payouts. What about people?
Jobs. That gets cut too. Employment drops by about 3% in that first year, and the cumulative job loss over the long term is over 5.5%.
Oof. So the picture emerging from that data is, well, it looks like activism historically pushes companies towards financial optimization, getting cash out now, but potentially at the expense of the long-term investments in innovation, productivity, and people.
That's what the historical U.S. data strongly suggests, yes.
Okay, how does this context apply here in the Korean market? Activism's really taken off recently. What kicked that off?
A couple of key things. Allowing foreign mergers and acquisitions back in 1998 opened the door. But the really big catalyst recently was in 2018 when the National Pension Service, the NPS, a huge player, adopted the Stewardship Code.
The Stewardship Code, remind us what that is.
It's essentially a set of principles encouraging large institutional investors, like pension funds, to be more active owners, to engage with companies, vote their shares thoughtfully, and generally push for better governance. It gave institutions like the NPS a clear mandate to be more active.
And the impact was immediate.
Pretty dramatic. The number of Korean companies targeted by activists just exploded. It jumped almost tenfold, 9.6 times. Actually, from only 3 companies targeted in 2017 to 77 companies in 2023.
Wow. And we started seeing domestic funds having success, too.
Absolutely. Think about KCGI, sometimes called the Kangzong-bu Fund. Their campaign targeting Hanjin KL back in 2018 really showed that a local fund could take on a major conglomerate and make substantial returns, reportedly around 300 billion KRW profit.
And foreign funds are active here, too, often focusing on specific Korean governance issues.
Yes, particularly the issue of KD, or spin-off listings. That's when a company spins off a valuable subsidiary, like a battery business, and lists it separately on the stock market.
Which can dilute the value for shareholders of the original parent company, right?
Exactly. And we've seen funds like Palliser raise this issue, for example, with LG Chem concerning the LG Energy Solution listing. They argue it harms the parent company shareholders.
Now, there's a potential legal change on the horizon that could really shake things up, isn't there? The proposed revision to the Commercial Act.
Yes, this could be a very big deal. The proposal is to expand the fiduciary duty of company directors. Currently, their primary legal duty is to the company itself.
Okay.
The proposed change would expand that duty to the company and shareholders.
Ah, so explicitly making directors legally responsible for protecting shareholder interests, too.
Precisely. If that passes, it could give activists much stronger legal grounds to challenge actions they see as value-destroying, like those spin-off listings. It adds legal teeth.
Interesting. But activism itself is also changing, evolving beyond just financial demands. You mentioned ESG activism.
That's right. This is a newer but growing trend. ESG stands for environmental, social, and governance.
So it's broader than just profits.
Much broader. ESG activists consider the impact on a wider range of stakeholders, employees, customers, the environment, society, not just the shareholders' bottom line. And their approach is often different, too.
How so? Less aggressive?
Generally, yes. They tend to favor dialogue, building coalitions with other investors, and working with the company to improve its long-term sustainability and social responsibility, alongside financial performance.
Does that actually work? Does focusing on ESG help the bottom line?
Well, the research emerging on this is quite positive. Studies are showing that successful ESG engagement often leads to improvements in governance, but also in financial metrics like return on assets, ROA, and overall profitability. It supports the idea of a double bottom line, doing good and doing well financially can go hand in hand.
So, given all this pressure, whether it's traditional financial activism or newer ESG activism, what should companies do? How do they survive or even thrive?
The best defense isn't just fighting back, which, as we saw, is incredibly costly. It's really about two things: proactive engagement and strong fundamentals.
Talking to activists early.
Yes, engaging with them early, understanding their concerns, maybe finding common ground before it escalates into an expensive public battle like a proxy contest. But even more fundamentally,
It comes back to the core business.
it comes back to avoiding the damage we saw in that U.S. data. Companies need to demonstrate they are investing for the long term, maintaining solid CapEx, investing in R&D, supporting employment, showing that they're building sustainable value, not just focus on the next quarter's dividend. That makes them a much harder target for purely financially motivated activists.
Okay, so let's try to bring this all together. It sounds like shareholder activism, despite the risks, can be a really important positive force, especially in markets like Korea, where governance might traditionally be weaker. It pushes for accountability.
I think that's fair. It can provide a necessary stimulus. But we absolutely cannot ignore that empirical data from the U.S. The warning signs are clear. Focusing too much on short-term financial engineering, driven by activist pressure, carries a real risk of damaging long-term investment, innovation, and ultimately value.
Which leaves us, and you the listener, with a really tricky question to think about. We see efforts to improve oversight, like potentially expanding that fiduciary duty in the law. But how do we find the right legal and regulatory balance? How do we encourage necessary shareholder oversight without pushing companies into that defensive, short-sighted financial optimization that cuts CapEx and jobs, potentially leading to the kind of market stagnation we've seen elsewhere, sacrificing real long-term growth for quick returns?
That is the critical challenge. Finding that sweet spot is crucial for everyone involved: shareholders, managers, policymakers, and the economy as a whole.
A fascinating and complex topic. This has been a really insightful deep dive. We'll be back soon exploring another compelling area.
Yeah, John Sean.